loud. Okay, it says it's recording. So what do? I do this, share screen. Okay, you can see those slides?
Perfect.
Yes.
Okay, great. So I suppose I can start. I'll time myself. I've got a stopwatch here. So I'm Tom Holden from the Bundesbank. I'm going to be presenting a robust monetary rule. The rule is robust in the sense that it works, it produces determinacy, essentially independent of the rest of the model. And if you're watching this and you want to see the paper or the slides, there are links there to see it. Okay. So let me motivate this paper with the fragility of the Taylor principle. Okay, so just to recap, the Taylor principle says that if the central bank wants to achieve determinacy, that means it wants to rule out self-fulfilling fluctuations and sunspots, then the central bank needs to respond more than 1-for-1 to inflation. If inflation goes up by 1%, nominal interest rates have to increase by more than 1%. So this is sufficient for determinacy in simple NK models, but it's not particularly robust across model features. So for example, the Taylor principle is insufficient if there's a fraction of hand-to-mouth households, if there's firm-specific capital, or if there's government spending that's sufficiently high, or even if there's a positive inflation target. Perhaps more worryingly, the Taylor principle actually inverts if there are enough hand-to-mouth households, or if there are certain financial frictions, or even non-rational expectations. This means that if a central bank wants to get determinacy, they have to have a passive response to inflation. They have to respond less than 1-for-1 to inflation. So all of this is not very useful to a monetary policy maker. You know, faced with this literature, it's unclear whether a monetary policy maker should be responding aggressively to inflation or passively. So what am I going to do in this paper? Well, I present a family of monetary policy rules which guarantee determinate inflation under the weakest possible assumptions on the rest of the economy. Okay, so these rules are going to be robust to heterogeneity, to non-rational households or firms. They're going to be independent of the nature of the nominal rigidities, and the existence or slope of the Phillips curve is not going to matter. And more than that, these rules don't just enable the determinate implementation of zero inflation, they enable the determinate implementation of an arbitrary path for inflation that's optionally a function of the complete history of structural shocks in the economy. And again, this works robustly across models. Okay, so rules from this family can automatically match observed inflation dynamics or any model's optimal policy prescriptions. Thus, the rules can attain high welfare, and this is even true when we restrict them to be simple, in the sense that will become clear. And these simple rules also match US Fed behavior quite well. So let me give a first example of what these rules are like. So for these rules to work, there need to be two bonds traded in the economy, a nominal bond and a real bond. So by real bond, I mean something like Treasury inflation protected securities, TIPS. So to be clear, if you spend $1 to buy a nominal bond today, T, next period, you're going to get 1 plus IT dollars. If you buy a real bond today, you spend $1 on a real bond today, next period, you get 1 plus RT plus pi T plus $1. Okay, where here IT is the nominal interest rate, RT is the real interest rate, pi T plus 1 is realized inflation between T and T plus 1. And as is standard, if these two bonds are traded in an economy, there's going to be arbitrage between the two. So we get the usual Fisher equation. Okay. So for now, we're abstracting from inflation risk or term liquidity premia. So we have a simple Fisher equation without a risk premium term. And the central bank in this world is going to use what I'm calling a real rate rule. It's going to set nominal rates equal to real rates plus something times inflation. Okay, so we've got two equations. We've got the Fisher equation and the real rate rule. Fisher equation says I minus R is expected inflation. The real rate rule says I minus R is phi times pi. Okay, so this equation is going to govern the evolution of inflation. Expected inflation is just phi times current inflation. And as long as phi is bigger than 1, so the Taylor principle is satisfied, there's a unique non-explosive solution in which inflation is always equal to 0. Okay, so this gives us determinate inflation. So this is incredibly simple. Why is this a good thing? Well, it's robust. So first reason why it's robust is we haven't used the Euler equation here. So we don't need an aggregate Euler equation to hold. This immediately means that the rule is robust to heterogeneous households or hand-to-mouth agents. It's also going to be robust to non-rational household expectations. All we need is that Fisher equation to hold. So when does the Fisher equation hold? Well, as long as there are two deep-pocketed, fully informed rational agents in the economy trading with each other, that's enough to get a Fisher equation. Or maybe people are not fully informed, but there's a large market with dispersed information, that will also recover the Fisher equation. So we really don't need very much for the Fisher equation to hold. More generally, the Fisher equation, because it's about arbitrage between nominal and real bonds, this is what matters is the expectations of financial market participants, not households. And it seems much more natural to assume that financial market participants have rational expectations than to assume that households have rational expectations. Turns out we can go even further and we can relax the rational expectations requirement for financial market participants even. All we need is that on average, financial market participants have correct expectations. So there can be a gap between rational expectations and their expectations as long as that gap is stationary. So people eventually get to rational expectations. Second reason why this is robust is that, again, we haven't mentioned the Phillips curve. It doesn't matter how prices are being set. It doesn't matter what the aggregate Phillips curve is like. Okay, so people are worried at the moment that the slope of the Phillips curve is declining. This is not going to matter for determining inflation here. Doesn't matter if the Phillips curve is forward or backward looking. Doesn't matter if firms have rational expectations or some other way of forming expectations. So if the central bank was truly unconcerned with output and unemployment, then they wouldn't need to care about the Phillips curve or its slope at all. They could pin down inflation completely independent of the Phillips curve. Of course, in reality, central banks do care about the output gap. But for such central banks, the Phillips curve is telling them what the output gap will be given a level of inflation. Okay, so the causation in the Phillips curve is running in the opposite direction to how people have traditionally thought about it. The level of inflation is determining the output gap, not the other way around. So what do we require? We do need one thing about price setting, and that's that at least some prices are adjusted each period using current information. If all prices were set one period in advance, then clearly there's nothing the central bank could do to influence the price level today. So there has to be at least some prices which adjust each period. But any standard model of price adjustment frictions will have some firms adjusting prices each period. So I'm not the first person to use a rule in which there's a response to real rates. So Adao, Correa, and Telej use such a rule, as do I in another paper, and Lubick, Mathers, and Mertens. But this is always done just for analytic convenience. It wasn't about the determinacy properties of such rules. The closest prior work to this is a working paper and a blog post by Cochrane on spread targeting. So in the working paper, Cochrane briefly considers rules of the form I is R plus phi pi, but he very rapidly sets phi equal to 0 because he's working under the physical theory of the price level. So in his world, inflation is determined by the fiscal theory of the price level, so he doesn't need an active central bank in order to determine inflation. And there's a lot of other related work, so this is not a particularly new idea. So back in 1990, Hexel proposed using the spread between nominal and real bonds to guide policy. Dowd in 94 proposed targeting the price at price level futures contracts. So our rules will effectively control expected inflation. So it's much like controlling the future price level. And more recently, Hall and Rice have proposed rules which give determinacy by a slightly different method, some of which require real rates to be observed. So in those rules, they make interest on reserves a function of price level deviations. So if you have $1 in reserves today, you might get 1 plus RT, PT plus 1 over PT star tomorrow, and that clearly will determine PT equal to PT star is for unique equilibrium. The difficulty with the Hall and Rice rules is that if there wasn't another reason to hold reserves, they would be dominated assets. So then that motive to hold reserves is going to end up having an impact on the price level. So let me generalize these rules a little bit. So the first natural thing to do is to add a monetary policy shock. The monetary policy shock is going to permit inflation to move. So we're now going to suppose the central bank uses the rule I is R plus 5 pi plus zeta. Okay, and zeta is going to be an AR1 process with some persistence rho. So again, combining the monetary rule with the Fisher equation, we have that expected inflation is 5 pi plus zeta, and this has a unique solution of this form. Inflation is minus something times the monetary policy shock. So this has quite conventional implications. If there's a contractionary monetary policy shock, so that's an increase in zeta, then inflation is going to go down. If the central bank is more aggressive, that means phi is larger, then inflation is going to be less volatile. This is just like in a standard model. But as before, we can understand inflation dynamics without knowing the rest of the economy. The monetary policy shock is the only thing driving inflation here.
Mm. So Tom, I mean, this is really, I mean, it's fascinating, no? Because, you know, here in a sense, it's, you know, Friedman, back to, it's sort of like a, you know, inflation is always and everywhere a monetary phenomenon, right? It's this exciting shock, and markup shocks are in fact going to have no inflationary effects. Even if you have a shock in the Phillips curve, as you say, you know, it's just going to be drive output and not inflation, right? That's how it's going to be.
So when so one way to answer that is to think about optimal policy in this world. And an optimal policy is going to require the central bank to make the monetary policy shock correlated with the other structural shocks in the economy, including, say, the markup shock. So if the central bank is behaving optimally, it will still look like inflation is moving because of markup shocks. But you know, that movement will be because the central bank is deciding that inflation should be moving because of markup shocks. So I think the nice thing about these, you know, the fact that you get this solution where inflation is kind of independent of the rest of the economy, and it's just the monetary policy shocks that are driving things, is that it's giving a good explanation for some of these recent findings on the poor performance of the Phillips curve for forecasting. So the empirical evidence seems to suggest that the output gap is just not very useful for forecasting inflation. There have been some theoretical explanations. So for example, McLean and Tenreiro, they show that if the central bank is behaving optimally, then you can't identify these parameters of the Phillips curve. We have a kind of simpler explanation that the causation in the Phillips curve is just running from inflation to the output gap. So it's not going to be the case that the output gap is going to help you forecast inflation, because that's not the direction in which the causation is running in the Phillips curve. And I think this is quite well supported by the empirical evidence. So that, for example, when you .c4g to start paper, find that an integrated moving average 1-1 model doesn't just beat Phillips curve-based forecasts unconditionally, but it also beats them conditional on the state of the economy as well. So I guess we're interested in knowing what the consequences for real rates and the output gap would be if the central bank followed a rule like this. So let's suppose the central bank is using a rule of the same type as before. So inflation is just as before. Well, now we've got a process for inflation in terms of a monetary policy shock. We can plug that into the Phillips curve. Got an entirely standard Phillips curve, and that's going to determine the output gap as a function of the monetary policy shock and the markup shock. Okay, so the Phillips curve is implying that X is decreasing in the monetary policy shock. Okay, so contractionary monetary policy shock is going to reduce output as you would expect. And it also makes clear why the output gap is not useful for forecasting inflation, because the optimal forecast of inflation, remember that zeta is following an AR1 process. So the optimal forecast of inflation is just going to be rho times current inflation. So once you know current inflation, there's just no extra information in X. You know, maybe X is telling you something about these shocks, but there's nothing extra you can learn. You can already make the efficient forecast just from the current level of inflation. We can go further and we can plug this expression for the output gap into the Euler equation in order to get an expression for the real rate. Okay, so here R is the real rate, as I said before, N is the natural rate. Okay, and I've slightly generalized the Euler equation here to allow for possible discounting or compounding. So this is that delta parameter. A standard Euler equation would have delta equal 1 and var sigma equal to the elasticity of intertemporal substitution. Our rules are going to continue to work even if delta is not 1 and var sigma is something completely different. So so if we plug in this expression for the output gap into the Euler equation, we can back out an expression for the real rate. So this says the real rate is going to be the natural rate plus a linear combination of the two shocks in the model. And the interesting thing is that we've derived this equation without ever solving the Euler equation forward. Now, if you compare this to a standard New Keynesian model, if you wanted to derive an expression for the real rate, you would have to iterate the Euler equation forward to infinity and then use the transversality constraint in order to pin down what's happening at infinity. Here we haven't had to do that. This means we're automatically going to be robust to differing degrees of discounting or compounding in the Euler equation. We're just not going to have any impact on determinacy. It also means we're going to be robust to transversality constraints not being there, I don't know, because it's an OLG economy, for example, or maybe because people just don't understand transversality constraints. So we're going to have the Taylor principle is going to be necessary and sufficient for determinacy, independent of all of these parameters. This contrasts with results from the prior literature. Okay, so for example, Bilby 2019 found the Taylor principle was only sufficient for determinacy in discounting case when you have delta less or equal to 1. And Bilby 2008 found Taylor principle was only sufficient for determinacy when var sigma was positive. We don't have either of those restrictions. So this means we're still going to have the Taylor principle being necessary and sufficient, even if there's limited asset market participation, like in Bilby 2008, or even if there's the richer structure of heterogeneity in Bilby 2019. I show in the paper that this is also robust to having a non-unit response to real rates. As long as you respond approximately 1-for-1 to real rates, that's enough. It doesn't have to be precisely 1. So we can still further generalize these rules. So the first thing we can do is to specify a process for the target of inflation. Okay, so pi t star is going to be an exogenous stochastic process possibly a function of the economy's other shocks that the central bank is going to decide. Okay, so the central bank has a target for inflation, pi t star. And we're going to consider a rule of this form: I is R plus the expected value of the target next period plus phi times the gap between current inflation and its target. As before, we combine this with the Fisher equation and we get an expression of this form. So the gap between targeted present and targeted actual and targeted future inflation is phi times the gap between actual and targeted current inflation. So with phi bigger than 1, just as before, there's a unique determinate solution of inflation always being equal to this inflation target. This means the central bank can hit an arbitrary path for inflation. So, for example, the central bank can implement optimal policy with a rule of this form. You know, if they set pi t star to be the process for inflation that inflation would follow under optimal policy, then the central bank can determinately implement that policy. So there's an older literature on the implementation of optimal policy via rules. And you know, some of these rules that people come up with are quite complicated and quite fragile, maybe not robust across models. This is a way of implementing optimal policy that's robust across models, not fragile at all.
So Tom, may I ask a question on that? I mean, you in a sense, I thought the strength here of this rule is that if you don't the central bank is not sure about the model environment, this is a way to always ensure a determinate equilibrium.
Yeah.
But if I'm not really sure about the true model environment, you know, how can I implement the, you know, I think you can say you can always, the central bank with this can always hit an arbitrary path for inflation.
Sure.
But you wouldn't know, right, as a central bank, if that's the optimal policy path or not, because the presumption here is that you don't know the true model environment. If I knew the true model environment, then I could, you know, minimize that loss function and, you know, through and have, you know, a standard rule with, you know, Lagrangian multipliers and, you know, the commitment. But so that's one thought I had. I just wanted to hear your opinion on that. But then, you know, suppose that in a given model environment, I presume that this is not generally an optimal policy rule, right, Tom? It will not in general be an optimal policy rule. You know, it would require more than this, right?
Okay, so on your first point, yeah, I think that's a fair comment. So yeah, if you can form optimal policy, yes, I guess you need to have a model in mind in order to form optimal policy. But still, this rule means that you can form optimal policy with what your best guess at what the true model is. And then you can set interest rates in this way, where pi t star is what's coming from the optimal policy. And even if your belief about the model was wrong, you know, at least you're going to have determinist inflation. Okay, you might not be optimal anymore, but at least you're still going to have determinist inflation, which maybe wouldn't be true with some other ways of implementing optimal policy. And then on your second point, is optimal policy going to be of this form? You know, once you allow pi t star to be arbitrary, so an arbitrary function of the history of shocks in the model, then optimal policy always can be represented in this form. So the unconditional optimal policy. Policy on commitment is something different, right? Because then, you know, it's not stationary anymore, but unconditionally optimal policy can always be implemented by a rule of this kind, choosing pi t star appropriately. And I talk a bit more about policy a bit later.
Okay, thanks.
So how, I guess a natural question that I get asked is, how would you implement this in practice? Okay, inflation protected securities are only issued occasionally. So you certainly couldn't set an overnight rate on inflation protected securities. So you're probably going to end up targeting longer rates than overnight rates. Okay, so in this example, I'm going to suppose they're targeting 5-year returns. Another problem with long maturities is that the risk and term liquidity premium are all going to be bigger. And we also want to be robust to the additional complication that inflation is observed with a lag. So in the US, it's 1 month for CPI. So a bit of notation. I is going to be the nominal yield per period on a 5-year nominal bond. R is the real yield per period on a TIPS bond. T is going to be the number of periods in 5 years, so like 60 if we're monthly. L is this information lag. New T minus L is going to be the risk, etc., premium on 5-year bonds, nominal bonds relative to real bonds. And this can also capture departures from fully rational expectations amongst financial market participants. And finally, new bar T minus L is going to be the central bank's belief about the level of new T minus L. So the central bank might not know what the risk premium actually is. So in this world, we get a Fisher equation of this form. I minus R is the risk premium plus the expected average inflation over the lifetime of a bond. We're going to suppose the central bank uses a rule of this form. So I minus R is their belief about the risk premium plus average expected targeted inflation plus the gap between inflation and targeted inflation. And just as before, when we combine the two equations, as long as phi is bigger than 1, we have a unique solution that says inflation is its target plus the expected deviation between central bank beliefs about this risk premium and actual risk premium going into the future. These A coefficients decrease quite quickly as J increases. And the important thing is that the larger phi is, the smaller are the A coefficients. So if the central bank is sufficiently aggressive, then inflation is going to be approximately equal to its target. So even with all of these extra complications, the central bank is still essentially able to hit pi equals pi star independent of the rest of the model. Let me skip that a bit. So just on welfare, yes, I kind of said this already, real rate rules, because they can determinately implement an arbitrary path for inflation, they can obviously implement optimal policy. So it's kind of trivial that they can attain high welfare. So for this to be a reasonable exercise, we need to restrict the rules a bit to simple rules. What does simple mean here? Simple mean simple dynamics of the targeted inflation. And I suppose my claim is that looking for optimal simple inflation dynamics is a useful approach to thinking about policy. So we can always think about optimal policy as what are the implied dynamics for inflation under this optimal policy. So in the paper, I go through 2 exercises. So I look at MA0, MA1, ARMA 1.1 inflation policy in the simple NK model. MA0 turns out to be what you get under discretion. ARMA 1.1 is what you get in the fully optimal, unconditionally optimal policy. So, you know, that's a fairly simple rule, gives you completely optimal policy. And then I do something in a larger DSG medium scale model, so this model of Justiniano, Primacheri, and Tambalotti. And there I show that if the central bank targets dynamics of inflation that are an ARMA 1.2, responding to all of the structural shocks in the model, then the resulting policy is very close to the true optimal, fully optimal policy. And I guess the intuition for that is that why such a simple process is enough is that optimal inflation is much less persistent than realized inflation. So you really don't need many lags in order to capture optimal inflation dynamics. In the paper,
can I ask you, Tom, quick question? So just the JPT model, that's the model without the markup shocks, is that correct? So it really doesn't have any big trade-off shocks in terms of output gap and inflation stabilization, is that correct?
Does it not have markup shocks?
I thought they had like an inflation target shock, you know, so that they used to argue that. So that's the paper. Is that the AJ Macro paper?
AJ Macro one, yeah.
I think they worked with inflation target shocks, so they really wanted to play down the markup shocks. So that's the AJ Macro. There's no trade-off, right, between inflation and output gap stabilization. That's the
yeah. So maybe, yeah, that's a good point. So maybe that's a slightly bad bad example.
Yeah, maybe it would be nice to think about the model where, you know, it would be fun to think, you know, like Smets and Wouters, Tom, where you have a trade-off with the markup shocks if you interpret.
So in Smets and Wouters, I've done some empirical exercises. So I've estimated the performance of ARMA 1.1 rules within Smets and Wouters. So just on the empirics, I find that these rules actually beat the original model in terms of both inflation and nominal rate root mean squared error. So it might not be surprising that they beat in terms of inflation root mean squared error, but the fact that they predict nominal rates better, that does seem kind of surprising to me. And I go on in the Smets and Wouters world to look at how reasonable these estimated ARMA 1.1 rules. So I compare them to optimally chosen ARMA 1.1 rules. And it turns out the estimated rules are pretty close to the optimal ones of that class. So it's still not quite an answer to your question, but you know, yeah, I've done some work in that direction. Maybe I need a different medium scale model in which I can look at policy with markup shocks. It's a good idea. And I'm kind of over time, so I've also done some direct estimation on monthly data using survey expectations, and I'm able to reconcile the TIPS measures and the SPF measures quite well. And the estimates are all quite reasonable. The maximum likelihood phi is 1.56, which is about as standard as you could hope for. Okay, so I'm kind of over time, so I will skip my conclusion slide. I guess if anyone has any more questions.
So I have one more question, Mauricio, if you don't mind. I just want to ask, so Tom, I mean, I think it's a nice pitch, but in the beginning, I wonder if you know, can you tell us that you would be able to take some model and have like plausible parameters in a sense where this, you know, you could have this non-robustness. You know, you talk sort of qualitatively about a high G, you know, it would be sort of nice to you know, for you to bring forward some reasonable, you know, which have these elements, and you can say, look at this, fairly reasonable numbers, and I can actually have an issue in that context with the Taylor principle not being sufficient. I
think what you get out of these heterogeneous agent models, you get a lot of discounting, you know, kind of calibrations people are putting to these heterogeneous agent models. They're like an Euler equation with a huge amount of discounting. And I think the calibrations for the hand-to-mouth households for that to flip, they're not completely crazy. But yeah, that's a good question. And I'm not sure I'm aware of empirical work that's estimated models allowing for the possibility of indeterminacy coming from, you know, one of these things flipping. Okay, so maybe we should move on to Maurizio. Thanks so much for all your questions, and hopefully we'll have some more questions in the Q&A session. So yeah, so next up is Maurizio Bergerin, who's a full professor at the economics department from the University of Brasilia in Brazil. And he's going to be talking about elections, heterogeneity of central bankers, and inflationary pressure. So let me mute. Maurizio, it's over to you. I can't hear you. Maybe it's on my end. Can you hear him, Jesper?
No, I think Mauricio, you're muted. You have to just unmute, I think.
Yes, I am muted now.
Okay,
Sorry. Can you see my screen share?
Perfect, no problem.
Oh, great. Well, let me start saying that it's a great pleasure and an honor to be part of this 12th World Congress of the Econometric Society. The paper I'm presenting here is co-authored with Fábia Carvalho from the Brazilian Central Bank. I'm Maurício Bergerin from the University of Brasilia. And the goal of this paper is to better understand the role of social heterogeneity on the recession costs of disinflation monetary policies. I will explain more specifically what social heterogeneity means here, and to understand the effect of having staggered terms for a country's president and the central bank's chairman in an inflation targeting regime where targets are exogenously determined. So to start with, to try to motivate, just recall that the inflation targeting regime, it's a novelty that started in 1970 with New Zealand and Chile, and it became very popular throughout the years. By the early 2000s, there were some 25 countries under that regime. And what is a striking characteristic of that regime is that, well, the central banker is supposed to follow a target. However, in the greatest majority of the countries, the target is not set by the central bank itself. It's set either by the government or by a joint committee involving the central bank and the government. However, the literature on signaling in monetary policy, it precedes inflation targeting. And in that literature, either there is not targeting at all, or if there is a targeting, it is directly chosen by the central bank. So to give a very quick review, the seminal papers are Kidland and Prescott, 1977, and Barrow and Gordon, 1983. In those papers, the central bank's inability to commit to a non-inflationary policy yields a Pareto inferior solution. That's the typical time inconsistency situation where society anticipates what the central bank is going to do. So there is high inflation and no output growth. Backus and Driffill in 1995, and especially Vickers in 1996, introduced a two-period game where there is incomplete information about the central bank's type, who could be stronger or weaker. And the central bank acts strategically, but in their model, there is this implicit target to be zero, and there is no announcement. Kuckerman in Leviathan in 1995 does introduce an announcement of the inflation target, but this announcement is made strategically by the central bank, who is able to choose completely the target. And there is this additional technical assumption that a strong central bank will always implement its announced policy. That paper, that is a two-period paper, has been extended by Walsh in 2001 and by Bulgari and Carvalho in 2005 to an infinitely repeated policy game, but the same assumptions are kept. In other words, the central bank announces the target strategically, and the strong central banker can commit. In this paper, we assume that departs from the idea that it's more natural to take inflation targets as exogenous, and no, we do not impose this strong commitment hypothesis that one type of central bank will always achieve the target. We use the intuitive criterion to refine equilibria, and we discuss what would be the effect of having the terms of the central banker coincide with the term of the president, or having it to be different. So the main results, to make the point clear here, is that we call we characterize a heterogeneous society as one in which there are very different opinions regarding the trade-offs between inflation and output, so that a central banker could be very tough, very focused on reaching the target, or could be, on the other hand, more focused on creating unexpected output or unexpected inflation that would generate an output cap. And we take as given that the central bank has fixed terms. Now, the main result is that when societies are heterogeneous in the sense that central bankers are maybe very different, then in order to signal that a strong central banker is really strong, then you have to adopt very tough monetary policy, which has the potential to yield very high recession costs of these inflation policies. And moreover, when the president and the central bank terms coincide, so that the president nominates the central banker when he is sworn in, then this situation remains the same as in the basic model, as if there were no information about the central bank. Whereas when the terms are staggered, so that the president has to bear with an already existing central bank for a few years, then this high cost that we highlighted in heterogeneous societies may be much lower. So the conclusion is that heterogeneous societies have a harder time dealing with inflationary pressures, and this is more so if the nation's president and the central banker's terms coincide. So this is the message of this paper. So we use the typical reduced form models. So those who work in central banks may hate this, because we assume that the central banker may implement whatever inflation it wants. Exactly. So basically, there is a cost of deviating from the target, and there is a benefit from creating an unexpected inflation, because that creates output. There are two types of central bankers, and the difference between the two types is that one of them, the lambda type, is the strong type. He cares little about creating unexpected inflation, whereas the weak type cares a lot about the output gap. All society knows is that the ex-ante probability of being strong is low. So this would be the solution of this game that society plays with the central banker in this one period game. Simply the strong central banker is going to choose this inflation, that's the target plus a little bit, and the weak, the target plus a bit more. And society will set an expected inflation rate to be something between the two of them. Therefore, both inflation expectations and realized inflations are above the target in that situation, even for the strong central banker. But still, inflation targets works as an anchor, since all decisions are taken based on the target. Now, the more interesting case in that one we want to explore is when there are two periods. And for the sake of simplicity, we suppose it's the same target in both of them. So the game society plays with the central banker is this. Nature chooses the type of the central banker, and then society creates its expectations about what's going to be inflation in period one without knowing the type of the central banker. Then the central banker, be it strong or weak, will effectively implement the realized first period inflation. Then society observes the realized inflation, updates its beliefs, and sets the new expected inflation rate for the next period. Once the society signs the contracts based on the new expected inflation rates, then the central banker chooses the second period inflation rate. The payoffs for society are what society wants is to guess or to create the best possible expectations. And there is a discount factor, delta, that tells us that whatever happens tomorrow is less valued than whatever happens in the first period. And the same thing for the central banker. This is the utility we have seen in the first period, and then in the second period with the discount factor delta. And then we solve this problem and apply the refinement of the intuitive criterion to look for both separating equilibria and pooling equilibria. And what we find for the separating equilibria can be resumed or can be explained in this graph here, where...
Before you go on, could you possibly just remind us of what the intuitive criterion states?
The intuitive criterion basically says that if you are out of the equilibrium, and out of the equilibrium, someone takes a decision, here would be the choice of inflation, then that the only type that could be that could take that decision would be a type that could possibly benefit from that. So if out of the equilibrium there were a change in beliefs on the other player, society, and that change of beliefs could benefit that type, then he would do it. But if no matter what, he wouldn't have a benefit of that, then I'm sure that this type would not take that decision. So that allows us to exclude some of the possible solutions. We only accept possible solutions where out of the equilibrium, some types could get a benefit of that. So that's just to reduce and get a clear view of the more reasonable equilibria. But we'll see, we still keep some interesting pooling equilibria. But for the separating equilibrium, if you have on the X rate the discount factor, and on the Y-axis the quotient lambda over mu, then when lambda over mu is very high, when you are in this region, then the types are very similar. Whereas if you are in this region here, where it's very low, mu is much bigger than lambda. So the types are very different. And what do we find? Well, in order to have a separating equilibrium, the strong central banker needs to push inflation possibly to lower than it would do in a complete information case, which is the one period solution. And in order to make the other type of central banker, the weak one, not to imitate him. And what we find is that in this region here, there is costless signaling, in the sense that if the central banker chooses the optimal complete information inflation rate, it already distinguished himself from the weak. Now, if you go a little bit up in that region, then we see that the central banker needs to reduce further inflation in order to distinguish himself from the weak one, but it's still above the target. So we say that in that case that there is low cost signaling, And what you could notice that, of course, we expect delta to be very much close to 1. So in that region, so this would be most probably in the situation of a homogeneous society where the difference in the central bankers is not too big. Is lower than 1. The quotient is higher than 1/2. Now, in that region here, then not only the strong central banker needs to reduce inflation, realized inflation in order to signal that he's really strong, but he needs to do it below the target. So in that case, we say that there is high signaling cost, and this is more likely in heterogeneous societies where the possible types of central bankers are very different. So this is the first important result that we find here, is that in societies where there's no consensus, where there's a lot of diversity in opinion about what is a good monetary policy, what are the right trade-offs, how they should be weighted, then we would expect that a strong central bank, one who cares a lot about following the target, to be very tough and to even actually choose below the target inflation rates. Now, what happens with the pooling equilibrium? The pooling equilibrium may not always exist, but when it exists, it's above, it's in the region of the homogeneous society. So in heterogeneous societies, if I define heterogeneous societies lower than half, then there will be no pooling equilibrium. And of course, there is a role for credibility here. Rho is the ex-ante expected expectation of the central banker being strong. The bigger rho, the higher this area, but still would never reach 1/2. So those are the main. Well, just a brief comment why a pooling equilibrium might be interesting. Well, in a pooling equilibrium that survives the intuitive criterion, what society expects is the realized inflation in the first period. There is divergence in the second one, but there is no surprise in the first one. And in the separating equilibrium is the opposite. There is surprise in the first period, and there is no surprise in the second period. Now, since the second period is less valued than the first, society prefers no surprise in the first period. So a pooling equilibrium might be desirable to society, and that might not exist in heterogeneous societies. Now, what is the role of this institution of the central bank versus the president? Well, let's include another player. And the new player in this game is the president, who is being elected now. So the question is, when does the president nominate the new central banker for a fixed term that has the same length, for simplicity, as the president? Well, it could be coincident, as is the case in Brazil. The president is elected, he's sworn in, and then he nominates the new central banker. Or it could be staggered, as is the case in the US. The president is elected, he has to wait another 2 years and then nominates the new chairman of the central bank. What is the effect of that? Well, let's define what are the utilities of those players. The society we know, it's trying to guess correctly what will be the inflation. The president is just like previously. He has a weight that tells what's important to him, following the target or creating output, just like we had before. Now, the central banker has his own preferences, just like the president, but he might be affected by the preferences of the president. So here, this parameter gamma says how strong is the influence of the president over the central banker. If gamma is close to zero, for example, so there is no influence at all. So basically, the central banker has his own opinions. If it's close to 1, then it's the central banker is a puppet of the president, reflects completely the president's opinions and ideas. So let's now consider the two possible institutions. When the terms coincide, what we would expect is that the central bank, the president will choose a central banker that represents his own view. So the central banker's type actually will be the president's type. In that case, nothing changed with regards to the previous analysis. Society doesn't know because a new president is coming in, is being elected, so society doesn't know the type of the president, therefore doesn't know the type of the central banker. Therefore, there will be this high cost of signaling once the new government starts. So the uncertainty that we found there for the central banker is basically the same because it reflects the uncertainty of the president who is being elected. Now, what happens if there are staggered terms? Well, in that case, when the president comes in, he has to bear with the old central banker. And the old central banker has been there for a while, so he has already revealed his type to society. So, and because we are supposing fixed terms, the president cannot just change the central banker. So we expect that the president will not influence or will influence very little the central banker's utility. In that case, society basically knows what's going on with monetary policy in the next period, regardless of the change in government. Therefore, all this signaling cost disappears, okay? And so we are able, by making the terms staggered, to get rid, and that's of the cost of signaling, and that's especially important in heterogeneous societies. So to give you an example of that, let's compare what happened in 2001 in the United States when Bush was elected, and 2 years later, in 2002 in Brazil, when Lula was elected for the first time. You can see that in the United States, there was a little bit of a pressure here in interest rates. It decreased in May, but it's remained steady. And as soon as the new president took office, it came back very quickly to what it was in January of the election year. So there was a very little action there. In Brazil, on the other hand, by September, when it was clear that an opposition president, left-wing president, had big chances of being elected, there was a strong inflationary pressure that required the central bank to increase by 6 percentage points the interest rates. And even after Lula was elected, the new governor of the central bank still increased in interest rate and kept it high. It took almost a year to get back to pre-election interest rates. And what happened in Brazil, as I explained to you, the new president nominates a new chair of the central bank. And before Lula, it was Arminio Fraga. After Lula was Enrique Meirelles. Both of them exposed, we know, they were tough, strong central bankers, so they wanted to control inflation. But Meirelles came with Lula, so there was a strong cost in order to signal that he really was strong, that the country has to bear. Whereas in the United States, it was Alan Greenspan. Everybody knew him. Everybody knew he was very tough on inflation. There was not much of an inflation pressure there.
So, Mauricio, may I just ask a question? I mean, so here, I guess this is the mechanism here seems like in the case you're describing is important that you don't have, say, a strong monetary framework, some sort of, right? If you have a strong framework, everyone knows that you have an inflation target and it's you have the central bank has to put up a credible inflation forecast.
Right.
And then it seems less of an issue, whereas maybe in countries where you don't have a strong
Right.
sort of a framework, then
That's true. That's true. If what you call a strong framework would say basically that monetary policy works in spite of politics, right? So politics is it doesn't cause so much of a trouble to have an election. However, in other countries, especially in countries where the central bank is not so independent, and especially where the president nominates the central banker, then this bond exists very strongly, and that's what the idea is, what the paper is all about. Yeah. So this paper is especially applied to developing countries where this issue of monetary policy is not completely settled yet.
Yeah.
Mm-hmm. So to conclude very quickly, I think it's about time. We were able to extend the basic literature by introducing this natural idea that inflation target is not a strategic choice of the central bank, but exogenous giving, and taking out this assumption that a strong central banker will always comply with the target. And we find that targets, in spite of that, are not usually met. And for highly heterogeneous society, then we might observe realized inflation way below the target when there is a change in government, which has happened several times in Brazil, in order for the new central banker to credibly commit or credibly signal that he is really strong. So we could see that of another version of what we call the country cost, in the sense that recessions are stronger and economic slowdown is stronger when a new government takes place than in countries where, as you say, the monetary framework is already well established. And that makes still more important for developing countries to have this separation between the terms of the president and the terms of the central banker, because even if the president has some influence on the central banker, this influence will be lower because the central bank has already shown a little bit of his type to society. So this is the paper, and let me finish saying thank you in Portuguese, obrigado.
Very nice.
If you have questions, I'm happy to know how we are in time.
So I was thinking, in addition, I mean, an alternative to now the model, you have like a president and the central banker, which is like a governor, implicit, I guess, is that there's a one-person monetary policy committee. But I was thinking one other push, one other way to sell this is to say, it's important with the monetary policy committee so that a new president, assuming office, cannot switch the decision process at the bank, by just bringing a new governor. If it's a monetary policy committee which has overlapping terms,
right,
and which sometimes can have, say, a 12-year, a very much longer mandate. A given member of that committee can have a longer. It seems like another solution as well.
Yes, indeed, that also would work, right? Even if the president may nominate the new chairman, if he has to choose among the long-term monetary policy committee, then that would also restrain, and reduce the asymmetric information, because society may already know the opinions of those members. Yes, indeed.
Gotcha.
Okay, so that's perfect timing, exactly 30 minutes according to my
thank you
timer. So Next up is Jesper Linde, who's going to be talking about resolving the missing deflation puzzle. Maurizio, if you could stop sharing your screen. I don't think Jesper can share. Okay, now you should be able to share.
Very good. Let me see if I can get this to work. All right, you see it? And I can flip. Now, let me see how I move this forward. All right, so that seems to work, no? All right, thank you, Tom, for this. So this paper is joint work with Matthias Trabant at the Freie University of Berlin. It's a pleasure to be here and present this work. So it's a thing we worked on, basically stemming from the global financial crisis, but the issues we touch upon in this paper might also, in fact, now be relevant during this COVID crisis. So key observations during the Great Recession or the global financial crisis was, an extraordinary contraction in GDP, but only a very modest drop in inflation. As you see, GDP fell some persistent 10%, as you can see from the lower left panel, whereas inflation only fed modestly, but maybe over some time, one percentage points. And that's evidence based on Christian Eichenbaum and Trabant paper in AG Macro. So it's a very small elasticity between the very persistent drop in output and lower inflation rate in the US economy. This small drop in inflation has been referred to as the missing deflation puzzle. And, various people has worked on this issue to sort of try to square models with this feature of the data. And, the New York Fed president, John Williams, said in a speech before coming president at the New York Fed that, the surprise about inflation is that it's falling so little given the depth and duration of the recent downturn. Based on the experience of passive recession, I would have expected inflation to fall by twice as much as it has. So a lot of people were surprised about how little inflation moved in the face of this very large output contraction. Of course, there is academic work who try to talk to this issue. So one set of literature, that Tom touched upon, emphasizes very flat Phillips curve. So that's the work, by, for instance, Marco Del Negro and Mark Giannoni and Frank Schorfeide. But then there are a couple of papers who sort of instead stress financial frictions as a way to reconcile the low inflation with the sort of small fall in inflation with a large output gap drop. And that is Simon Gilchrist and Ralph Schoenlen and Jay Sim and Egon Zakrzajsek has worked on this. Now, those sort of mechanisms, when they discuss this, is sort of part of linearized models. And here we're going to propose in this paper an alternative resolution of the puzzle, which is based on nonlinearities in price and wage setting when the economy is exposed to large shocks. So that's, it's going to be a different route here to explain why inflation fell so little. So what we do in the paper is to study inflation and output dynamics in linearized and nonlinear formulations of the standard Newcastle model. And the key feature we have is to allow for real rigidity to reconcile the macro evidence of a low Phillips curve slope and the micro evidence of frequent price resetting. And the real rigidity I'm talking about is this Miles-Kimball 1995 state-dependent demand elasticity. And we're gonna, use this small little tweak in the standard a new Keynesian model to look into the implications for propagation of shocks, large shocks. Now we're talking about large shocks, so like big recessionary shocks. We're going to look at nonlinear Phillips curves for prices and wages, how they look like, and also some unconditional distribution of inflation to see if the model can account for the skewness of inflation that we see in the data.
So,
all right.
Yes,
Yeah.
at the Summer Institute this year, there was a paper by Bohm and Pandali Naya on convex supply curves, and they were also explaining the missing deflation puzzle with some extra convexity. Is it a similar story here?
Yeah, so this is, you know, I must confess, Tom, I haven't seen the paper. I know that there's a new paper out. Our paper has been around for some time, in fact, now. But you know, I guess it is, you know, that sounds similar to what we're doing here, I must say, although I haven't seen the paper. So this is, you know, these are features on the supply side of the economy. So it goes through the optimal price setting of firms, Tom. So that it sounds similar in that sense. When I say state-dependent demand elasticity here, I mean from the perspective of the aggregation, the demand for intermediate goods. So it's a supply side thing in the economy. All right. So thank you for notifying me about that reference. We should look into it. All right. So the benchmark model we're going to use is the Erskine-Henderson-Levin standard model. So it's monopolistic competition, and the Calvo sticky prices and wages is going to be, for now, a fixed aggregate capital stock. So there is no endogenous capital formation. And you know, the sort of only tweak is that we allow for a CLB constraint on the nominal interest rate. Then we're going to look into robustness in a sort of workhorse Christiana Eichenbaum-Evans, Metz and Wouters model with endogenous capital. Right. So the outline for the talk is to talk you through the results in the benchmark model. You know, present the model, how we parameterize it, and what we get, and then, you know, do the analysis, time permitting, in the estimated model in this Christian Eichenbaum, Metz and Wouters model, and then conclude. All right. So you know, competitive firms aggregate intermediate inputs into final good YT using this technology. And this technology, the G function, we specify following Dodson-King and Levin, Lopez, Saludo, and Yoon, as this very complicated thing, where there is a psi p there, which is important. So that's if psi p is smaller than 0, you are sort of in the Kimball world, and you know, if you make it pretty low, you're very much so. If you set psi p to 0, this complicated G function actually just simplifies the standard Dixit-Stiglitz linear demand schedule. And the key implication of the Kimball aggregator is that the demand elasticity for intermediate goods is an increasing function of the relative price. And this naturally dampens firm price response to changes to marginal cost. So we can, you know, look at how this looks like in this simple graph. And you have relative demand on the x-axis, so YF and over aggregate Y, log scale. And then you have relative price on the y-axis. And when you set this psi p equal to 0, you have that, you know, this is just a linear relationship, right? It's just it's a linearized relationship. And so it's standard. So that demand elasticity between relative demand and relative price is constant. Now, when you go to Kimball and you start tweaking this parameter allowed to be negative, you see that you start to kink. So people talk about this quasi-kink demand curve. So at some point, if you go, for instance, to the red line and you have a shock, and what you see there's basically, if the firm is cutting its relative price, it cannot crowd in too much demand. You sort of get stuck. You don't crowd in more demand, even if you cut your relative price a lot when you get the chance to reoptimize. So then naturally, of course, then firms, you have less incentives to cut their prices because they cannot, they figure that they cannot crowd in that much demand. And that's going to be key in a recession when they want to cut the relative price. In the Kimball aggregator, a small shock, when you just close to the steady state, basically it's going to be similar. But for large shocks, when you have a very recession or big shock, you're going to come down to this quadrant where it's not going to be of interest for firms to cut their prices much. So you're going to have this nonlinear pricing functions. And an alternative way to try to shed some light on this is to show you the profit functions, how they look like. So in the upper left panel here, we show the Kimball case and the baseline. So we have a markup here of 10%. So they're making 10%, basically close to 10% profits here when the relative price is 1. And then we consider, simple static model plus minus 5% changes the marginal cost. And what you see in this Kimball, if you look at the upper right, you see that they keep they're going to keep the relative, the markup constant. So you increase, if you have a cut in the marginal cost, you cut your price 5%. And if you have an increase in marginal cost, you increase it. So you keep the real marginal cost constant. Now in the Kimball world, that's you're not gonna you're gonna move the markup, and you also see that for a decline in marginal cost, which is like a recession, you're gonna cut the price by less than you actually increase the price if you have a positive markup shock. Positive marginal cost shock. So, so you see that and, the lower two panels sort of shows you that convexity. You see that if you have a markup, you see that you get a banana out of the Kimball price where you respond more for an increase in marginal cost and you respond less than a linearized model would suggest when you have a decrease in marginal cost. So that you see for large shocks, you get more and more notable differences between the linearized and the nonlinear formulation of the same model. For small shocks, they're of course the same, but for larger shocks, you're gonna get an important difference between a linearized and nonlinear model. Whereas in the Dixit-Stiglitz world, there is basically no difference between the nonlinear and linearized formulation of that model. So that is what we're gonna, this is the key to the paper, and it's basically all you need to know. So then of course there is a production function technology here, where you have a fixed capital stock and you have endogenous labor here moving around. For simplicity here, we gonna assume that if you're not allowed to reoptimize your price, you're gonna index to to the steady state inflation rate. So there is no steady state price distortion, but we've also in fact solved this model for Ascari, when you don't allow for indexation for non-optimizing firms, so you have a steady state distortion. That is not key here. And there is a fixed aggregate capital stock, so how much capital each firm has is constant when you aggregate it. All right, that's on the firm side. It's very simple. And the household side, you have you get utility from consuming and you get this utility from working. And the shock that's going to be key that we're going to look into is this var sigma t, a discount factor shock. That's the standard shock that many people have used to think about the great global financial crisis, the Great Recession, as a shortfall in demand. So that's a shock that doesn't move potential output, it moves the potential real rate. So monetary policy, if unconstrained, would like to mimic this shock and hence could provide perfect stabilization. So it's in that sense a demand shock. And there is a standard budget constraint. Consumption expenditures plus your savings bonds equals your wage income, your income from capital holdings, physical capital, your interest earnings on government bonds, and you also have profit. You rebate any profits here are rebated to the share owners. That's the households. And also you have the sticky wages here in the background, which I will not describe. The problem is basically the same as the firms I just described. So you get the union share revenues too, to preserve the representative agent formulation of the model. All right, so there's going to be a standard Euler equation coming out of this, where this, the only non-standard feature here is this delta t, possibly where, you have this, that's the exogenous shock we're going to consider here. That's the ratio of this var sigma, the discount factor shock to in the next period to over today's period. And as I said, the Calvo price sticking is the same conceptual setup as for sticky prices discussed previously. All right, finally, they're going to be an aggregate resource constraint. So, there's no endogenous investment here. There's no government spending. So it's a one sector economy. And so what is aggregate production goes to, value added, I should say, goes to consumption. But, given that there are this price and wage dispersion terms, you actually, all the resources used for production, all the capital labor used are not eventually going to be turned into effective output. It's going to be this distortion terms works as a tax basically on that. So you get a bit lower output than what is, would have been produced in a perfect competition framework in world. All right. Monetary policy here is a simple Taylor rule with this zero low bound output here, potential output here. So you respond to inflation when inflation deviates from the central bank's target, and then you also have output. You respond. The central bank is assumed to respond to the output gap, where this white pot denotes the flex price wage output level. And then, that's the nonlinear formulation of the rule. In the linearized model, we instead write the Taylor rule, as you see below, as a simple linearized rule, and there you can, zero low bound that we impose here would mean that you can go to minus I. And then you have responding to inflation deviation from this target and the output gap. So in logs, xt is then log yt minus yt pot. All right, so, we solved this linearized and nonlinear model using this Fair-Taylor algorithm. So that's a two-point boundary value problem. And what we want to have here is that the solution of the nonlinear model imposes certainty equivalent here because it's a perfect foresight method, just as the linearized model solution does by definition. And in a sense, then the solution algorithm traces out implications, the sort of really the partial implications of not linearizing the equilibrium conditions, and these computations can be done in Dinaire, so it's a deterministic perfect foresight simulation. I just want to say that for those who are interested in shock uncertainty to assess what shock uncertainty might imply for the solution, I would be happy to talk to Tom about this too, who's an expert on these issues. But what we have found in our own work is that allowing for shock uncertainty and look at the, fully global stochastic solution, it's not very different from the perfect foresight solution. We have found, at least in a framework with flat Phillips curve, so expected inflation doesn't move much to future shock uncertainty. I think you can really get a big kick out of this future shock uncertainties. Either you have considered not a very you consider fairly poor policy rule, so policy rule doesn't stabilize inflation expectations well, or when the Phillips curve has a much higher slope, so that expected inflation moves a lot to shocks, and then you can get a big kick. It's going to be a big disparity between the perfect foresight and the fully stochastic solution. But I think for a fairly good rule, and also with a very flat Phillips curve, those differences will be at least smaller, I think so. And we compared we have a Journal of Applied Econometrics paper, Matthias and I, where we compared the perfect foresight with this global solution for a similar model, and show that the differences are fairly small. But of course, that's just examples and not really a general statement. All right, so that's the model. Parameterization, so microevidence would suggest 3/4 price contracts. We could do 4 as well, but somewhere there, 3 to 4, the results will not be sensitive to this. We work with a 10% markup, and then, given those parameters, if we now want to have like a slope in a Phillips curve, as you see, that is kappa p, roughly in line with estimates saying Gali, Gertler, and Spardoni, or Alti, Christian Eichenbaum, Linde, of say 0.01, then, basically those two parameters and the discounting parameter beta close to unity, which you want if you want to have a reasonable real rate, then that implies that you need a fairly negative Kimball parameter in our framework. So we work with psi p minus 12.2 in the benchmark. Now with wage setting, we work with 4/4 wage contracts. So psi w is 0.75. Then you get this on the wage block of the model, that psi w is -6, or roughly half of what you have in the pricing block of the model. And that -6 actually turns out to be an approximate estimate in this the model that we're going to estimate later down the road. I'll tell you about it. All right, the other parameters are fairly standard. The only thing I want to note here is that this delta t shock follows an AR1 with root 0.95. So now we come to the numerical results. So we're going to follow the CLB literature and assume a negative demand shock hits the economy. And so there's going to be this discount factor shock delta t rises by 1% and then receding with a root of 0.95. And this is the result of that. So here we compare a nonlinear model is the red dashed, and the linearized model is the blue solid line. And the first column shows when we don't impose the zero low bound, and the second column, the right column, shows results when we impose the zero low bound on the equilibrium. All right, and now, so if you look at the difference, I'm going to cover this pretty quickly. So you see that if unconstrained, the nominal rate will fall below 0 for some time. Inflation will fall from its target steady state of 2%. In the linearized model, just below 0, and the output gap will fall roughly 4%, almost 4%. And then, start to rise again. Now you see that in the nonlinear model, that's the interesting part, inflation doesn't fall as much on impact and actually rebounds quicker than in the linearized model. So actually, if you look, say, after 4 quarters, you have roughly inflation around 0 in the linearized model, whereas it is, almost 1% in the nonlinear model. So it's a sizable difference in the response of inflation between the linearized and non-linear model. Now that's the unconstrained, when monetary policy is not constrained by the zero low bound. So now move to the right column when monetary policy is constrained. So then you get a sizable liquidity trap or the CLB episode in the linearized model. And what you see there is that, so inflation, that will mean that inflation in particular, I should say the output gap falls even more, of course, then in when the zero low bound binds. So now you're, falls over 6%. And that causes inflation now to fall into deflationary territory for almost, for about a year in the linearized model. Now, in the nonlinear model, what you see is that output falls much more, so over maybe somewhat around 5%. But if you compare inflation in the two, in the nonlinear model, when you impose the zero low bound and don't impose the zero low bound, you see that that's basically like the same line. So the inflation doesn't move more just because I impose the zero low bound and output falls less. That's because you basically come to a completely flat portion of the Phillips curve, where no inflation is no longer responding to the output gap. The recession is so severe that the firms that are allowed to optimize, they're gonna choose to adjust their prices very little to the deterioration in economic activity, because they perceive basically that the demand is basically vertical, so they get no further profits from cutting rates. So the
decompose the sources of these nonlinearities, just linearize all equations apart from the Phillips curve and see what happens, and same with other equations. It'd be interesting to see if it really is all going through that Kimball parameter.
Exactly.
Nonlinearities.
That's a great question, Tom. And we didn't do so here, but we did so in this Journal of Applied Econometrics paper, Tom. When we looked at focus on government spending multipliers and compare them in linearized and the nonlinear model. And there we, that was actually a model without sticky wages. So maybe we should look at it again. But in the model without sticky wages, it's all coming through this Phillips curve. It's nothing, on the demand side, you get nothing. So it's really this. So we did exactly what you asked there. So it's a great comment, of course. Yeah, so that's an important thing. Thank you for pointing it out. So the key here is that demand elasticity falls when the relative price of a firm falls. Thus, the firm's ability to increase demand by cutting price is limited. And a large price cut results in lower profits because demand would increase only by little. Hence, there's little incentive for firms to cut prices a lot, so they don't move. And this nonlinearity is going to be stronger the deeper the recession. So linearization can then, in this case, for large shocks, I should stress this is for large shocks, you see these differences, not for small shocks, but for large shocks, linearization may produce large approximation errors. So we think that this offers one way possible, not saying the only way, but one additional reason why we saw a very muted inflation response in the Great Recession. And most likely, it's going to be interesting to see if that holds up now also during the COVID crisis, although some people have argued that the COVID crisis might not lead to low inflation because it's like a mix of supply and demand. But the Great Recession arguably was more like a demand. All right, so we do, stochastic simulations. That's the next step of the analysis, to look at linearized and this nonlinear feature with this discount factor shocks. We subject both models to long sequence of this discount factor shocks. And we're gonna set the variance in both the linearized and nonlinear models so that the probability of hitting the zero low bound is the same in both type of models. And we simulate data. So we simulate a sequence of 10,000 observations. And in the left panel here, you see the nonlinear model. In the right panel, you see the linearized. And you can see already here, just look at the top row, and you're gonna see that the nonlinear model very basically never features inflation below zero, versus the linearized model, we're gonna have several episodes with large negative inflation. So that means that, if I plot Phillips curve, which would be, say, a negative output gap versus on the x-axis versus inflation on the y-axis. You know, for the linearized model, of course, that schedule is all linear until the point for the blue, that's the blue circles, until the point when you start to hit the zero low bound, and then you will get a kink. So you flatten the slope a little bit. So that's the kink in the blue line. Without the zero low bound, this would just be a straight linear line. But you see that the Kimball aggregator with the Kimball, the nonlinear model, features basically a banana Phillips curve, strong banana, and you have the classical Phillips, really the classical Phillips curve in a sense. And we do so for wages too, so it's a similar story. There, wages can actually go somewhat negative. It's not only, but almost, you know, it's almost like a endogenous model of downward nominal wage rigidity here. But you get this banana Phillips curves. All right, so I think I'm running low on time now. Isn't that true, Tom?
You're like 30 seconds over.
Oh, I'm sorry, even 30 seconds. So I'm just going to say we do robustness in a workhorse model that we estimate. You know, we estimate the parameters and get basically Kimball parameters. We're going to get, you know, condition on sticky price parameters that fits the micro evidence of 3 4/4. We basically get similar Kimball parameters that I already used in the Erskine-Henderson-Levin model. And we use this model to look at the Great Recession, how the model, you know, this allowing for Kimball, the nonlinear features, may help you to explain why inflation fell so little, given a large deterioration in output. And then we use this model to look at these inflation densities, where we argue that this nonlinear formulation of the Phillips curve really helps you to fit the asymmetry in inflation densities that you see. And that goes for both core PCE inflation, as you see, that's the red line, matches the gray area very well, and the blue line is the symmetric, the linearized model, which, you know, has notable mass below zero. Same is true for hourly earnings. So we think that it's sort of interesting to think more about the nonlinearities and price setting, especially when the economy is exposed to large shocks. Thank you very much.
Okay, that's great. You know, both Phillips curves graphs are really compelling. You know, that should be like the first thing you show almost. They're so brilliant. They're really good. One thing I wanted to ask was whether there was any direct micro evidence on these Kimball parameters. You know, they're quite strange objects, these Kimball preferences, and it would be a bit more reassuring if there was some direct evidence on those parameters.
I agree very much. That's a great question, Tom, and I fully agree with that. So we are actually involved in working on this. I think there is some mixed evidence, I would say, Tom. Some papers do not seem to suggest that you have the micro evidence support the sort of as much Kimball as we need in this paper to really make this tick here. But I would say that this you know, this evidence doesn't really is not based on all the sort of data you would need according to our model. It's only implicit, indirect evidence, and not, I wouldn't say, not really strong evidence. But I think that's an important dimension to you know, look further into this issue, how well it could be. I mean, then of course, I think we don't want to sell this as this is the only thing that you need to have. I think we sell this also, you know, it's probably a one piece, and we certainly don't want to rule out, you know, like the financial friction story that you know, Gertler and Simon and has worked on. So a complementary piece. Thank you.
Okay, so if Maurizio doesn't have any more questions, then I guess we should wrap up. I'll stop the recording. And yeah, thanks to everyone for contributing. Thanks for all the questions. Super useful for me, at least. and hopefully we'll get some more questions when we do the Q&A in August, whenever it's happening. Okay.
So I just want to say, Tom and Marisa, thank you so much for your your flexibility. I'm Tom, I'm indebted, and Mauricio too. I'm so grateful that you're willing to do this. Thank you. And
no problem
thank
at
you
all.
so much for this. Tom, Mauricio, I really like your work. I work at IMF now, so I can really see where, these issues you're talking about. So very interesting, I thought. Tom, may I ask you, your paper, can you send that to me as well? If you have a paper that is ready, that would be very nice.
It's not completely finished for some to-dos in various places, but I'll send you.
I agree, but Mauricio, I'm more like a technical guy, so I like your work a lot, but maybe that's not my research area. But Tom's is really my research area.
Yeah, definitely. Yeah.
And maybe, Tom, if you knew that the reference, the bone paper you talked about.
Yeah, I'll send you that as well.
Pass that along would be fantastic.
Cool. Will do.
All right. Super
Okay,
nice. Thank you.
great.
Thank you both.
Thanks
Okay.
a lot.
Very nice meeting you. See you in August then, I guess.
Thank you all.
Okay. See you guys in August. All right. Bye-bye.
Bye.
Bye.